Hi. Today we are going to discuss as to how to assess the relative performance of mutual funds. So, as we know, there are quite a number of funds, mutual fund schemes, which are there in the market. Now, it's very difficult for an investor to really understand and interpret as to which is the fund where the investment needs to be done basis the performance in the past. So, one aspect is definitely the performance that was there in the past, but it's also very important to understand where things would move for that fund in the future. So, just to give you a sense that there are many funds where you get to see that there had been a very good return in the first 2 years, and suddenly there has been a dip, or there may be situations. I'm saying if you are studying, say, for the last 3 years perspective. So there has been a dip in the first 2 years, and suddenly the fund has given 60-70% return in the very third year. So now, how do you really analyze and interpret on all these sort of situations? So let's look into it. Let us understand, and let us break it up into smaller pieces so that it gets easy for us to understand as to how one should be going for analyzing in this set of situations. So the first thing that we need to understand that we generally as investors we have this habit of looking things purely from a return perspective, but uh, it needs to be understood that we shouldn't be looking at things only from a return perspective, but we need to also consider that what extent of risk has been undertaken in order to generate that extent of return, right? So now we need to understand that all returns are not the same. So suppose if two funds are generating say 20% return, that is not enough. One has to see what risk has been taken to generate that return, right? So that's very important. Analyzing risk is important as it has implication of future performance as well, right? So this is something that we have to keep in mind, that we need to look at things from a risk adjusted return perspective. Okay, so now what are the major factors that one needs to look into or understand? The first is definitely return, that is the present value of the investment that you are doing. The horizon, that's the duration of investment. And third is the risk, that is the appetite to generate that return, right? So better to look at risk adjusted return. uh, so to get a very easy perspective of things, we need to understand that the ratio we need to look at is return by risk. So higher the value of ratio, the better is the ratio, right? That's how we need to understand. Now, what are the ratios that one should be looking at? So choice of ratio depends on whatever risk return parameters you look at, right? So the risk return parameter would be different for different individuals. So it's basically touching the elephant from different sides. So it's all about what measure of return is relevant for you, what measure of risk is relevant for you. So basis your perspective of looking at returns, your ability to undertake risk, your lookout of certain ratios would be different, right? So the most important, or I should say, the most popular ratio that is commonly used in the mutual fund industry is the Sharpe ratio. So what is Sharpe ratio? It, as I mentioned above, we should be looking at risk adjusted return. So Sharpe ratio measures risk adjusted return. How is it computed? It is computed as return of fund minus risk free rate divided by standard deviation of the return of the fund, right? So the proxy of risk free rate is government bond yield, and standard deviation measures the overall volatility of returns, right? That is a thing that we need to understand. So it helps to identify how consistent has been the fund manager in generating the return, right? So this standard deviation at the in the denominator that we get to see, it measures the overall volatility of returns, and that helps us to understand how the fund manager had been performing in generating the returns, right? Because the better the lesser the deviation is, the better it is. So it's more applicable for retail investors whose investment horizon is limited. Sorry, there is a spelling mistake. So Sharpe ratio is primarily used by retail investors whose investment horizon is limited. Next is the trainer ratio. Trainer ratio also measures risk adjusted return, but over here it is only on in context of systematic risk. So what extent of risk is there in the system? Now in the case of Sharpe ratio, we have studied risk from an overall perspective, both systematic risk and unsystematic risk. So basically, risk of the risk which is prevalent in the market, in the entire system around, and the other is in terms of specific individual stock risk that is there, right? But over here in case of trainer ratio, the measure is more the risk measure is more from a systematic risk perspective. So here the calculation, the way it's done is return of fund minus risk free rate by beta of the fund, right? So beta measures the risk on account of overall market conditions, as we know. That is what definition is. So if beta is greater than 1, the portfolio is more volatile than the overall market, right? So if the overall market increases by say 10%, so if beta is greater than 1, then the portfolio is going to be more volatile. It's going to be more than 10%, right? And in similar manner, if the market falls by 10%, then the portfolio is also going to fall by more than 10%. So that is what beta stands for. So more applicable, so this trainer ratio is more applicable in case of diversified investors, that is who has invested, just a second, who has invested in multiple stocks, multiple countries, and multiple sectors, right? So because over here a person who is exposed to different multiple stocks, multiple countries, multiple sectors, they are the ones who would ideally like to see the trainer ratio more closely, as because it captures only the risk which is there in the system and not very focused into few stocks and the risk element attached to that. So for retail investors, we are looking the Sharpe ratio is more applicable, whereas in case of diversified investors or big investors like say I mean to say from a corporate perspective, who are investing huge amount of money in the mutual fund sector, they would be more worried about the trainer ratio, right? So these are two ratios that we discussed. Let's see the third one. So now we are going to discuss on ratio to assess the performance of fund manager in the bull and bear market. So there are two specific ratios where we get to understand how the fund manager has performed both in a bear market as well as in a bull market. Now to measure performance in the bull market, the ratio that is calculated is called upside capture ratio. Okay, so it is calculated as return of fund by return of benchmark. Okay, and you would like it to grow by more than 100%, right? So obviously if your benchmark has increased by say a certain percentage, you would like your the return of fund to be growing by more than 100% in case of a bull market sort of a situation. So upside capture ratio captures that aspect, right? Whereas in case of a bear market, the ratio that is computed is called downside capture ratio. So downside capture ratio, the calculation format remains the same, return of fund by return of benchmark, but we need to understand that this is in case of bear market. So how it is computed is like the set of months when the benchmark was positive. So those set of months are taken into computation for the upside capture ratio, and for the other set of months where the benchmark was has fallen and showed a bearish trend, those are the months computation returns that is taken for downside capture ratio calculation. Okay, so over here, in case of downside capture ratio, you would ideally like as an investor that your the growth, I would say the degrowth over here, because your performance has the growth has fallen. So you would like that to be lesser than 100%, because if the benchmark has fallen by 10%, you won't like the your stock portfolio to fall by 10%, but rather say 8%, 7%. You would like the lesser it is, the better it is. So it should be less than 100%. And in case of upside capture ratio, obviously you would like to get more return, so it should be more than 100%. I'll show you the places from where you can extract this piece of information, but now you try to understand things at a conceptual level. So we have till now discussed on Sharpe ratio, trainer ratio, upside capture ratio, and downside capture ratio. Next is information ratio. So information ratio measures returns over returns volatility. So basically it's return of fund by return of benchmark divided by standard deviation of the return of the fund. So essentially it is as similar as a Sharpe ratio, if you remember. So as in case of Sharpe, we have computed as return of fund minus risk-free rate by standard deviation of the return. So over here also the denominator remains the same, return of fund remains the same. The only difference is that in case of risk-free rate, in place of risk-free rate, we are using return of benchmark. Now who make use of this? It is not for retail investors, but it is primarily for investors who invest a lot in the equity space and who would like to generate more returns than what one can possibly earn out of investing in a benchmark fund, right? So that is when the focus is that is when one has to fall back on information ratio. So is the fund doing better than the benchmark? That remains the question over here. And indicate the value provided by the fund manager. So the higher returns fund generates in case of when we are interpreting through information ratio, if it is a positive figure, that is the fund has generated more returns than the benchmark, then obviously it shows that the fund manager has really done a good job, right? So that is how one assesses the performance of the fund and the fund manager, right? So this is the fifth ratio. And the other ratio, which is called the Sortino ratio, this is a typical ratio which is used with the perspective that what happens is in case of say a Sharpe ratio, we are trying to analyze the standard deviation, right, which interprets the risk. Now standard deviation is so interprets it in such a manner that if say a stock has a fund has performed very well, that also is not appreciated. Obviously if it is doing very bad, that's not appreciated, that everyone understand. But on the other side, if the stock is performing very well, if it's too varied from the mean, then either side is not really appreciated. But then many investors are there who really ask question around this, that why a fund which is performing much better, is giving very high returns, why they should be penalized, as because they have gone extreme on the positive side, right? So they then say that okay, we are not okay with the Sharpe ratio because of this characteristic. We need a ratio which only focuses on the negative part, in the sense if the returns are negative, then only the uh, ratio has to then only the thing has needs to be captured, right, the standard deviation. So uh, that is the context in which Sortino ratio came into the scheme of things. So Sortino ratio measures the risk only on the downside, as I just mentioned, and over here the calculation is return of fund minus return of benchmark, as we have seen in the last ratio, that is in case of information ratio. So this is also referred in context of benchmark, but over here semi deviation of return of the fund. That is how the Sortino ratio is interpreted. Now, as a investor, as a investor, you may not be getting into too much of computation, but then how which are the sources you have to really source this set of interpretations, right? The figures, you would like to get the figures so that it helps you to interpret on this set of things. So I'll show you two sources. One is a site called morningstar.in. So if you go to morningstar.in, right, and you search by any mutual fund which you are tracking over here, that mutual fund would appear, and once you click on that, this sort of a sheet would get appear, right? So over here, if you see, if you go to the risk and rating tab, this is where you would find the Sharpe ratio. Okay, so you will find the Sharpe ratio, and you will find the upside and downside capture ratios. Okay, so over here it's not getting let me try with some other funds, because the figures are not displaying. So let me see with this. Here also it's not getting displayed. Let's see, is TFC. I just wanted to show you how the downside and upside figures get to be shown out here. This is also not showing. Okay, so what I'll do, I'll show you this. I'll just identify this area. I'll just show you in some time as to a particular fund where I can show you how the upside and downside capture ratios are getting uh, reflected out here. The other site which you can fall back on is called the Value Research Online site, where over there also, if you go to the fund section and you go to the fund compare section, and try to compare between two funds, you will get to see this Sortino ratio, which is already computed. So these are the sources which you can fall back on in order to get a clear understanding as to what are the different ratio figures that are coming up for those individual funds. So it's not that you have to compute everything at your end, right? So I'll just get back with this fund which is reflecting the upside and downside part of it, right? As we see over here, this is the Morningstar sheet site, where in case of fund, we are getting to see the figures around Sharpe ratio over here, and the capture ratios, the upside and downside capture ratios. So as I was mentioning, in case of upside capture ratios, we would ideally like the thing to be more than 100%, right? Then only it shows a good performance. But as because it's below 100, that's why it is reflecting in red. And as we had discussed that one would ideally like to limit the downside to less than 100%, so that's why it is showing as in green, whereas once it is more than 100, it is showing in red, right? So this is where you can get the capture ratios and the Sharpe ratio. And if you want to understand what's the trainer figure, so as we know, both in case of Sharpe and trainer, the numerator remains the same. So just to calculate trainer ratio, you have to take the new like with Sharpe ratio, you need to multiply the standard deviation, the figure that you get over here, and divide it by the beta figure, right? So you will reach the trainer ratio. And as we see over here, other than the fund, these calculations are also done for the category for which the fund is related to, and as well as on the index part of it, right? So I hope you have got some sense around tracking the mutual funds, and getting to understand how a relative performance of mutual funds may be assessed, right? So see you in the next video. Thanks a lot.